Hello everyone, welcome to Ginger Market Weekly Update, Ground Reality Explained. Let's look at how the ginger market is performing this week and what is really happening in the ginger market. This video explains why Indian ginger prices are under pressure based strictly on ground level market behavior. For ginger related market insights, ground level trade news and exports updates, subscribe to our YouTube channel Brothers Ginger Traders. This is not a price prediction, this is a factual explanation of the current market situation. At the start of the harvest season in September October, ginger prices were expected to remain at a medium and realistic level. This mattered because medium pricing attracts Bangladesh and GCC buyers, adequate quantity moves into dry ginger processing, fresh supply stays controlled, keeping the market balanced. Instead of stability, a rupees 100 to 200 per quintal increase occurred early in the season. The rise was driven by market confusion, not actual demand. Though small, this sent an incorrect international price signal, made Indian ginger appear expensive during a critical export window. At the same time, Vietnam, Thailand, and China offered ginger at slightly lower prices. Bangladesh and GCC buyers shifted purchases to those origin. As a result, export momentum slowed during a crucial phase. A major demand channel was temporarily lost. And compared to previous years, earlier seasons saw around 100 trucks per day moving to Bangladesh, nearly 50 containers per day moving to GCC and other markets, large volumes converting into dry ginger. These movements kept supply and demand balanced. This season, only about 10% of normal movement occurred, exports weakened sharply, dry ginger conversion remained minimal. Due to early price increases, exports slowed down, circulation of unverified prices on social media, many farmers delayed harvesting, held stock longer in the fields, took selling decision based on forwarded messages, assumptions or expectations rather than confirmed demand or actual market movement. This misinformation driven holding increased field level stock pressure, led to sudden bulk arrivals when harvesting finally started, added to the current oversupply situation. When harvesting eventually began, large quantities entered market at the same time. Domestic demand was already saturated. Internal consumption could not absorb the volume immediately. This sudden oversupply is the direct cause of current price pressure. US tariff actions slowed exports and weakened dollar inflow. Foreign investment reduced, liquidity tightened, and the rupee weakened. Cost increased, spending became cautious, and bulk buying reduced. Because ginger demand is highly cash driven, capital is now blocked in unsold stock, cash rotation is slow, and payment cycles are weak. This fund pressure is not the cause but the result of weak demand and excess supply, and it is adding further pressure. Even small economic pressure leads to 10 to 15% drop in buying, where the pressure is visible across onion, garlic, and other agri commodities. Bangladesh and GCC markets act as pressure release channels. If export movement remains weak, excess stock stays domestic and price instability continues. This is not a prediction, only a risk explanation based on market logic. The current phase calls for capital protection, controlled trade volumes, and risk managed decision. Market balance can improve if prices realign with global levels, export flow resumes steadily, excess stock moves out of the system. This update is shared only for market awareness based on observed ground level data. Thank you.